Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture, Accounting for a Limited Company. We'll first take a look at the features of a limited company. The first of it is that it is a legal entity separated from its owners. It is capable of entering into transactions, hire and fire executives in addition to its owners. It can be transferred or sold to third parties or other entities. It can run or operate a bank account. It can sue and be sued, and can be taxed on its profits. Now, the managers of a limited company are known as directors, who are distinct from the shareholders, which is the owners. Shareholders need not necessarily run a limited company, and if they do, they will be wearing two different hats and performing two different roles. Shareholders' liability to the debts of the business is limited to the value of their shareholding and cannot be extended to their personal property. Lastly, there are more formalities required in establishing and running a limited liability. Example, many disclosures, auditing of financial statements, and what have you. We'll move on to talk about the capital structure of a limited company, juxtaposing it with the sole trader. Owner's contribution into a sole trading business is known as capital, and that of a limited company is a share capital. Sole trader makes profits, and money paid to its owners are term drawings. Now, the limited company also makes profits, but pays dividend to its shareholders. Capital for sole trader changes from year to year in the statement of financial position. It is increased or decreased by profit or loss respectively, as well as being reduced by drawings. For the limited company, the share capital remains unchanged unless there is introduction of new shares in a period. Now here, the profit and dividend are netted and presented separately from the share capital in the statement of financial position as retained earnings. Let's test our understanding. Now, Alex is a sole trader and Beta Limited is a limited company. They both start business with capital of $10,000. They both make profit in the first 3 years of trading of $5,000 in year 1, $7,000 in year 2, and $10,000 in year 3. Alex takes drawings and Beta pays dividends of the same amount each year as follows: $1,000 in year 1, $2,000 in year 2, and $3,000 in year 3. Now, you are required to show how the capital section of the statement of financial position would appear at the end of each of the 3 years for each business. Okay, so we'll first take a look at Alex, who is a sole trader. So we'll start with the opening capital. For year 1 is $10,000, as stated in the question. They made a profit of $5,000, so it will be added, giving $15,000. Then the drawings of $1,000 will be reduced. So in the statement of financial position, capital will be $14,000 for Alex. Now this capital will be the opening for year 2. Then we'll add the profits for year 2 and reduce the drawings, giving us a capital to be recorded of $19,000, which will then be moved to year 3 as an opening, add the profits of $10,000 and less the drawings of $3,000, giving a capital of $26,000. When we move to Beta Limited, it's going to be different. Their share capital of $10,000 will stand. There was no mention of additional capital being introduced. There will be a retained earnings introduced in the capital section of the statement of financial position. It's going to be the profits of $5,000 less the dividend of $1,000 in year 1, giving $4,000. Now, when we come to the year 2, that same capital of $10,000 stands. When we come to retained earnings, the closing for year 1 will now be brought into year 2, add the profits for year 2, then reduce the dividend to lead to a retained earnings of $9,000. When we move to year 3, the capital still stands. We'll add the profit of $10,000 to the retained earnings of year 2 of $9,000, giving $19,000. Then reduce the dividend of $3,000 from it, leading to a retained earnings of $16,000. We'll move on to the layout of the financial statement. Now, a company is to prepare 2 sets of statements of profit or loss. One for internal management, which is similar to that of the sole traders, which is a bit detailed. The second one is a summarized version, which is meant for the public. There will also be a tax charge on the company's profit in the statement of profit or loss. If the tax charge is unpaid at the end of the year, it is going to be recorded as a current liability in the statement of financial position as a current tax. In the statement of financial position, assets are recorded at their net book value, unlike the sole trader, where both costs and accumulated depreciation of the asset are presented. Now, in the limited company, the details of the cost and accumulated depreciation, as well as movement in the non-current assets, will be presented in a separate statement. There will also be the need to prepare a statement of changes in equity, which is to inform shareholders of the movement in equity, which is their funds. In addition, statement of cash flows will also be prepared in a limited company. Now, the statement of cash flow tells of the actual cash inflow and outflow for a period. Let's look at the extract of the statement of profit or loss. We'll have a revenue here, less the cost of sales. So the cost of sales is summarized there. In the sole trader type of business, we would have been broken down into the opening inventory, add the purchases for the period, then less closing inventory, which will lead to a gross profit of $60,000. So we add any other income available, less distribution costs, less administrative expenses, with less any finance costs, then it will lead to a profit before tax. Then the income tax is levied on the profit before tax. Then the profit for the year will be the profits before tax less the income tax. Now when we move to the statement of financial position, it is broken down into two columns, the asset side and the equity and liability side. The asset side is also broken down into two, non-current asset and current asset. So we bring the non-current asset here, property, plant and equipment. As we said earlier, the net book value is what is recorded here. So we bring the property, plant and equipment, the net book value. We bring the motor vehicles as well. Then the total of the non-current asset, which will give us $120,000. We move to the current assets, inventories, trade receivables, prepayment, and cash, leading to a total of $15,000. So the total assets, or the total of the upper column, will give us $135,000. So when we come to the equity and liability section, we'll start with the capital and reserves. We'll have the share capital, capital reserves, revenue reserves, leading to a capital and reserve figure of $107,000. Then we come to the non-current liability column. We have 10% loan notes of $20,000. Then we come to the current liabilities, trade and other payables, $2,000. Company tax, we add short-term borrowings, which will lead to a total current liabilities of $8,000. We add that to the total of the non-current liabilities and the total of the capital and the reserve, leading to $135,000. We move on to discuss the issue of shares. Our company issues shares to raise capital. For limited liability, ownership is in the form of shares. The share capital is the total value of a company's issued shares at the nominal value. Now, the nominal value is the unit price of the shares stated in the statutes of the company. Now, it is also the cost of the company's shares and the least the shares could be sold for. So when a share is sold at a price more than its nominal value, the excess or the profit is termed a premium. Therefore, share premium is the total value of a company's shares issued at that premium. Now, the share capital together with the share premium forms the equity of the business, but are presented separately in the statement of financial position. Let's test our understanding. A company is formed on 1st January 2015 and issues 100,000 50-cent shares. So this is how nominal shares are quoted. So the 50 cents is the nominal value of the shares at a share price of 50 cents each. So here the shares are being issued at their nominal value, so there's no premium. So show the necessary entries to record this transaction and what will appear in the statement of financial position under the heading equity. When we come to the solution, the share capital is going to be the 100,000 shares multiplied by the 50 cents, which will lead to $50,000. So it will be recorded under equity as share capital. Let's now test our understanding. The same company issued more shares on 30th June 2017. They issued another 200,000 at 50 cents shares at a price of 80 cents each. So there's a share premium in place here. Show the necessary entries to record this transaction and what will now appear in the statement of financial position. So when we come to the solution, we'll start with the share capital, which is going to be the 50,000 earlier issued plus what is currently issued, which is the 200,000 times the 50 cents, which will give us 100,000, arriving at $150,000. When we come to the share premium, we will pick the 200,000 multiplied by the difference between the 80 cents sold and the nominal value of the 50 cents, giving 30 cents. So the share premium account will now be $60,000. Now the share issues can be ordinary share or preference shares. Let's look at ordinary shares. Now ordinary share confers voting rights on its holders Holders are the last to receive dividends after debt holders and preference shareholders. Their dividends vary with the earnings of the business. That is, the more the business earns, the more they stand to benefit, and vice versa. There is no set maturity period for their investments or shares to be paid back to them. If they want to recoup their investment, they have to sell it out to other shareholders or other parties. On the other hand, preference shareholders have no voting rights. They receive fixed dividend each year and does not vary with the returns. Holders are given preference in dividend payment ahead of ordinary shareholders. Preference shares can be redeemable, which will be treated as a long-term debt. Its dividend will be recorded in the statement of profit or loss, similar to interest, and the investment, that is the preference share value, will be recorded in the non-current liability section of the statement of financial position. Preference share can also be irredeemable, which it will be treated similar to ordinary shares. Now here, its dividend will be charged against retained earnings and then recorded under the capital heading of the statement of financial position. Now, right issue is an invitation to current shareholders of a business to purchase additional shares in a ratio to their holding within a specific period. For example, a company may give 1 bonus share for every 2 shares held. This helps the business to seek or raise additional funding from within. Now, the shares offered are done at a discount to the market value. Shareholders have the right but are not obliged to take up the offer. Another issue of shares is the bonus issue. Now, bonus issue is also known as a scrip issue or a capitalization issue. It is an offer of free additional shares to existing shareholders, also in the constant ratio to the existing shareholding. For example, a company may give 1 bonus share for every 5 shares held. Now, bonus issue increases the company's shares but not its net assets. It is charged against available reserves. Now, a business uses bonus issue to pay shareholders in place of cash dividend. The shareholder may sell the shares to settle their liquidity issues. Now, bonus issue is also used to restructure the reserves of a business into ordinary shares. Let's test our understanding. At 31st December 2019, a company's capital structure was as follows. Share capital of $125,000, which is the 500,000 shares issued at 25 cents each. The share premium account was also $100,000. Now, during the year ended 31st December 2020, the company made a rights issue of 1 share for every 2 held at $1 per share, and this was fully taken up. Later in the year, the company made a bonus issue of 1 share for every 5 held, using the share premium account for the purpose. What will be the balances on the share capital and share premium account at 31st December 2020? So for the solution, the share capital is going to be $400,000, which will be the opening of $125,000. The rights issue was an offer of half of whatever holding a shareholder had. There was 500,000 shares available. Since it was fully taken up, there's going to be 250,000 shares issued. At $1, it's going to be $250,000. The bonus issue, on the other hand, was at a fifth of the total shares available. So a fifth of 500,000 is 100,000 at 25 cents, which will give us $25,000. The share premium account is going to be 75,000, which is the 100,000 stated in the question, reduced by the bonus issue of 25,000 as stated in the question. Let's move ahead to dividend. Now, a dividend is an income yielding on the investment of shareholders. So directors propose a dividend payable to shareholders depending on the performance of the business, whether they make a profit or loss. The shareholders would have to vote on the proposal at the annual general meeting. Now, there are 2 types of dividends. Interim dividend. This is proposed and paid in the course of the year. Interim financial statement is to be prepared to inform and enable the proposal. Now, interim dividend is to provide some earnings to the shareholders while awaiting for the final dividend. Final dividend, which is the second type of dividend, is the type that is proposed at the end of the accounting period. It is done after the final financial statement is prepared. Now, dividends are recorded in the year that are actually paid. Therefore, proposed dividend do not appear in the financial statement. And by extension, final dividend will always be recorded in a different year from the one it relates. Dividends are paid from retained earnings. So let's test our understanding. The company has a year end 31st December each year. During the year ended 31st December 2017, the following occurred. 1st March 2017, paid a final dividend for the year ended 31st December 2016, $10,000. So here, because the dividend was paid in 2017 but relates to 2016, it will be captured in this year's financial statement, 2017. 5th July 2017, paid an interim dividend for the year ended 31st December 2017 of $1,000. Now, the interim dividend was paid in 2017, so record it in the year ended 2017. at 31st December 2017, proposed a final dividend for the year ended 31st December 2017 of 6,000. Now, it is a proposal. It is not paid. So, it's not going to be recorded in 2017's account. Let's look at reserves. A reserve is anything that is owing to shareholders in addition to share capital. So, there are two types of reserve. Revenue reserve. These are distributable to shareholders in the form of dividends. Examples of which is a retained earning. Other type of reserve is a capital reserve. So, these are not distributable to shareholders in the form of dividends. Example of which is share premium and revaluation reserve. We've already spoken about share premium. So, let's tackle revaluation reserve. So, IAS 16 stipulates that an asset must be valued either under the cost model or the revaluation model. But an entity elects to value an asset under the revaluation model, it has to compare the fair value of the asset to the carrying amount. When the fair value exceeds the carrying amount, there is a revaluation reserve, otherwise known as revaluation surplus or the profit. Now, this revaluation reserve or surplus is an unrealized profit because the asset still sits in the books. It is only realized when the asset is sold. Because of that, it is shown separately from the statement of profit or loss and captured in the revaluation reserve under the other comprehensive income. Depreciation is now based on the revalued amount and the remaining economic life of the asset. Extra depreciation is transferred from the revaluation reserve to retained earnings. The revaluation reserve, as earlier stated, is a capital reserve. Let's come to statement of comprehensive income. Now, this is an extension of statement of profit or loss. It's everything prepared under the statement of profit or loss, in addition to other comprehensive income. Revenue less cost of sales, leading to gross profit, add other income, less distribution cost, less administrative expenses, less finance costs, arriving at profits before tax, less the company tax expense for the year, leading to profits for the year. Then the addition, which is the other comprehensive income. So if there's a surplus on revaluation from current assets, we bring them here 5,000. When we add it to the profit for the year, then the comprehensive income for the year is 25,000. So it means that for a particular year, statement of comprehensive income captures every earning that the company receives from the operations of the business and from other activities, such as the revaluation of the assets. Let's come to changes in equity. As explained earlier, statement of changes in equity explains the movement in the equity column to shareholders. So because of space, I have just itemized them here, but in real life, you're not supposed to initialize them here. So SC share capital, as explained by the bottom here. Share premium, you have the revaluation reserve, you have the retained earnings, and the total for each line. So you start with the opening balances for each of the items. So in this scenario, we assume we have an opening balance for share capital of 40,000, $27,000 for retained earnings, leading to a total of opening balances of 67,000. If there is a surplus on revaluation, that's the revaluation reserve, record it under the revaluation reserve column. The net profit for the year will be added to the retained earnings. If it was a loss, it will be less. The dividends paid for the year will less from the retained earnings, as said earlier. When shares are issued, record the share capital element, which is 10,000, and record the share premium element also under the share premium column. So the closing for share capital will be $50,000, which will be recorded in the financial position. The share premium will be $10,000. Revaluation reserve will be $5,000. Retained earnings will be $42,000. And the total for the equity, which is $107,000. Now, the summary of this is what is going to be carried into the statement of financial position. Okay, so it helps to sanitize the financial position, makes it easier for you to just list from here and take it in. So people, this is where we draw down the curtain on our discussion on accounting for limited companies. If you have any feedback, you have any question, don't hesitate to drop them in the comment section below, and we'll do our best to address them timely. So we'll come away again by way of tutorials on the go. Take care of yourself and stay blessed. Poker.